what markets do is they move and they revert, back to support or hit resistance. And when they retrace, they usually retrace back to another value area. And the values they're strong, it will continue on. And so gold is at this 10-year and 12-month value area. I've got no idea where it will go, but you can look at charts and you can look at this 10-year and this 12-month value area. Right? So this is like a discretionary idea.
Welcome everyone to I'm sitting down with Brent Penfold, a good friend of mine who we speak often. We have a good chat about risk trading, risk management, how to become more profitable. I read one of your book a long time ago, the first time. And it's kind of one opportunity in the podcast the first time. So looking forward to have you back here again. I believe it's like 4 or 5 years later. So looking forward to have a chat. Good to have you here, of course. Welcome to the podcast.
Thank you. Etienne, it's good to see you again. You're a regular face that I see. And it may sound strange, but I don't talk to many people. I don't choose to talk to people. I'm very happy in my own company. So you're one of the few regular people I talk to. So it's good to see you again.
That's awesome. So tell me a bit more about since we last spoke. I believe it's been a year or 2 years or so, but what's been going on since these past few years for you in trading?
Okay. Something that's a regular experience, which is a normal experience for traders. Last year, I came out of a drawdown, it's always good to come out of a drawdown because essentially, drawdown is what most traders fail to survive. And as you know from my books, the big focus of my books is managing risk. And, people may label us as traders, but I think our real job is that we are risk managers. And another key thing I talk about in my books is this idea of the market's maximum adversity, that when you least expect it, the market will just give you a slap to remind you that, it still exists and it's not going to make it easy for you. So, last couple of years, or certainly towards the middle of last year, I traded out of a significant drawdown, so I was thrilled about that. What I'm not thrilled about is that after recording new equity high, I'm straight back into another drawdown. So I'm currently in drawdown. I'd prefer to have enjoyed a longer period of just, linear, ebbs and flows, but just equity highs each month. Yeah, occasionally losing months, but unfortunately, it's not the case. Maximum adversity has just put me back into another drawdown. And so what's that? A lot of fun, but it's trading. And we least expect things. When you least expect bad things happen. When you least expect good things happen. So all I can do is just focus on the process of, essentially I divide, when I'm in drawdown, I have two main objectives. One is to ensure that my expectancy is still positive. And so I look at all my models, just see, what I can do to, improve it. Usually I can't because I trade quite simple models, so it's not really much to do. And I'm very hesitant to add layers of filters to models because all you're trying to do is, avoid that last couple of trades. And all you're doing is just adding fragility to your strategy. And another part of reviewing strategies is your equity momentum on individual strategies, positive or negative. And actually, in a drawdown, there'll be a number of strategies which have negative equity momentum. So I'll switch a couple of the models off, which I have done. And then, another half is to look at the portfolio. When you're losing money, you should trade less. And that's what I do. And so, I'm just here, underwater. My snorkel's not far from the top, but it's still underwater, so I'm just holding my breath. And it's normal life of a trader. So, so in terms of trading, it's been wonderful last year coming out of the drawdown, and it's been like being thrown into a cold bath this year, particularly over the last quarter. So, not a lot of fun, but it's trading. And in my last book, people call me a kill joy because my books aren't very uplifting, because I just spend a lot of time focusing more on the drawdown. And it's because if you survive a drawdown, well, that means that you enjoy new equity high, and very few people experience new equity highs. So if you can learn how to armor plate yourself so you can survive these tough times, then you will become a successful, not just a successful trader, but essentially a successful risk manager. Yeah. So that's all.
I like that you real about it, because a lot of people don't share the real drawdowns they go through, and that's some things that maybe we can talk about later. But a lot of people want to know how to get out of drawdowns. I think it's one thing which we can discuss also. But tell me more about what are some ways to avoid making your drawdown worse? Because sometimes you can go in a drawdown that's maybe just a few percent, but you make it worse with the things you do or the mindset you come in with. So how do you avoid making your drawdown worse than it really is?
Well, first of all, don't get caught in the mindset of revenge, right? Revenge. That you can't think, even though you know the market owes you because it's taking a chunk of money out of your account, you can't have the mindset to think that, you're entitled to get that money back. And you can't force the market to give it to you. So whatever you do, don't double your bet size, because it just takes well 2 trades and bang, you get all your money back. Don't do that, because the day you decide to step away from your risk management rules and just up your bets because you want to come out of your drawdown, I can assure you that will be the day that you will commence your longest and deepest future drawdown. You'll experience your longest streak of cumulative negative losses. So you just got to make yourself small. Okay. Now, drawdown's terrible because obviously you're using money. And one of the key ways of actually ensuring that you maintain your capital, or you don't lose all your capital, is you should switch off a couple of your models, right? Because they've got negative equity momentum. And it's really, really tough, because what usually follows drawdowns and new equity highs if you have a robust system. So it's a double-edged sword. You should be trading less because you're losing. But when you're trading less, if you're trading a good strategy, you'll be trading less when the equity curve pops up. And so you don't actually have your normal size on the trades. And so even though the strategy could be experiencing a new equity high, you don't. And that's the ironic thing, is that you're suffering. You want to jump off a couple of models. And, sometimes it's not a good idea, because if you've got a good strategy, it will turn north and it will trade you out. But you got to be realistic and go, yes, you hope your strategies do pick up, but you can't rely on a brand, right? It's all about capital preservation. In my book, I talk about risk of ruin, and I talk about the biggest crime that any trader can suffer or enact. The biggest crime is the loss of their capital, right? That's the biggest crime. And we should all have that tattoo on the back of our eyelids, right? To not lose your capital. Mm-hmm. So even though we know that, and we believe we trade good strategies, and my strategies, I believe, good, I do know in the future, I have a very strong expectation, strong expectation that my strategies, equity curves, will turn north in the future, but I don't know when. And even though I know they will turn north eventually, and I know that I will be disadvantaged by turning a few of those strategies off, so I don't get the quick uptick in my equity curve, I know my biggest risk is there's no way that I ever want to lose my risk capital. Yep. And so you just got to stay in your lanes, respect the guardrails, which is essentially you got to trade smaller, and you trade smaller either by turning off a couple of your worst performing strategies, the ones which have the deepest negative equity curve, because who's to know the equity curve won't go further down, right? Switch a few of those off. And then if you trade a portfolio of markets, look, well, certainly money management will tell you to trade less. The position size will be smaller. But another way you can actually reduce your trading size is look at your portfolio. If you trade multiple markets, look to trade less multiple markets. Does that make sense? So even though your position sizing should be going down because you're just losing money, so I trade fixed percentage, so I try to risk no more than 0.5% on the trade. So my 0.5% is getting less all the time, right? Because I won't risk more than a bit less than 0.5% of my risk capital. But another way to reduce your bet size is to reduce your portfolio. So I trade like 32 markets, okay, and across the eight market segments. So what I do sometimes is I'll chop that down from 32 to say 20 to 24, sometimes down to 16, and just trade a small portfolio. So it's a mix.
What can we tell people in terms of losing capital, like in the beginning of the trading career, that they might not have a strategy yet, or they might be not too sure what they trade, they might risk too much? Of course, risk reward is good, but how can you kind of minimize these losses early on in your journey in trading?
Oh, look, one thing that traders have today that I never had when I started trading are the new micro futures contracts, the mini contracts. That's another way you can reduce your position sizing. You don't trade the full contracts. Look to trade the mini contracts. A lot of those mini contracts are the 10th size. So you may have heard of CFDs, or Forex, which I think the concept is fantastic because it allows traders to customize or tailor their trade size to reflect appropriately their risk capital. The disadvantage of futures is that, one contract's a fixed size. You can't chop that down if you've got less capital. When you've got less capital, CFDs, Forex, you can, trade, you can customize your trade size, right? Which is fantastic. A big risk with Forex and CFDs is that you have huge third-party risk, right? But when you're trading through Forex or CFDs, you're not trading with another trader. You're trading with the provider. And you just hope, one, that provider won't do funny things with the prices, okay? Because they can stop you out. They want to be smart. And also, the biggest risk is you don't want them to go out of business, right? Because in Australia, certainly have a number of CFDs and Forex brokers going bust. And that's terrible for the trader. The great thing about futures is you don't have third-party risk, because with a futures exchange, through novation, the exchange, the way it's all set up, is that nobody can trade a futures contract unless it's got the appropriate margin to back it. So the futures exchange, guarantee the performance of each contract, so you don't have third-party risk. And today, with the micro, or the mini futures contracts, traders can trade a really good product or instrument without the risk of third-party default or somebody going bust. And they're tiny, they're so tiny. So even with $10,000 in your account, you could trade these mini contracts. You could trade one out of the grains, one out of a diversified portfolio. There's 8 sectors. You could trade one interest rate, one currencies, indices, a grain, a soft, a meat, a metal. Have a wonderful little diversified portfolio. And will you become a millionaire? No, you won't. Not in the first, second, or third year, right? But you will build up experience and a process of managing your $10,000. You may hit a 30% drawdown at some stage, maybe down to $7,000. But you're sensible, that will grow, and you will, stick to your plan, and you have a positive expectancy strategy. Okay, you take silly risks like, oh my God, I've experienced 20 losing trades. So, the next trade has to be a positive trade, right? And so avoid avoid the temptation of doubling up on your 21st trade, right? Do you think, okay, 20 losing trades, right? Well, the 21st has to be a winner, right? Avoid doubling up. Yeah, there's no magic wand on how to come out of a drawdown because you have no control over what the market will do or what your strategy will do. What we have control over is the exposure that we have to the market. We've got to minimize that as we're losing, and we've got to be patient. We've got to be patient. If you trade a good strategy, it will eventually, come good, and you'll be alive. You'll catch those trades. You may not be trading at your full size because you had to, reduce your position size because of the drawdown, but your strategy will reach a new equity high, and it will continue. And you'll be able to build up your position size. The account is moving up, and off you go. There's no magic. I don't know of any magic formula or trick, to basically trade out of a drawdown effortlessly. I don't know, but if you survive a drawdown, like intuitive. A trader will get so much confidence from that. Oh my God, I've done that. How good is that? And they'll be so well suited to be successful going forward because they've experienced and survived the first one. Just got to be patient. Be patient. Just trade small. Stick to your rules. And you'll be surprised. And when you do get a profitable trade, don't be anxious to bank that profit. Oh my God, it's a profit. I'm gonna close my position because I haven't had a win for a long time. Stick to your trade plan, okay? If you're a trend trader, let it accumulate. Yeah, you'll be a strong temptation to bank that profit, right? Because you've been experiencing so many losses. But it's all about sticking to your plan, right? I'm just telling you, you'll have temptations. I mean, I have temptations, and I say no, don't, because you don't know whether that's that copper or that Forex or that 10-year bond trade or the EBD trade. You don't know whether it's life cattle. That trade was coffee. You don't know whether those positions over the next 2 days, 2 weeks, 2 months. It's like takes you out of the hole. So unfortunately, I don't know any simple way, except to survive. You survive, then you're a champion, right? Because you maintained your risk capital, and you're still there, right?
A very good point there. And one thing that I hear you talk about a lot is this term evidence-based trading. So it's very clear to me what that means, but can you explain people more about what it is? Because it's not a term we hear everywhere. We hear about systematic trading, we hear about rule-based trading, but evidence-based trading is like a different term that people want to be familiar with. So
yeah, it's really all the same, isn't it? I mean, you and I know it's all basically the same. But a good way of describing, an approach that we should all embrace is that we want to see the evidence that the way we want to engage with the market, if we choose to follow that method of engagement, we want to see the evidence that over the longer term, it'll contribute more profit to your account than losses. So evidence is all about essentially developing a strategy and back testing it on historical data. So the evidence are these hypothetical trades that you collect, and you want to see the evidence that whatever idea you wish to follow to make your trades has an edge. So it's just a different way of saying systematic trading. Well, that's evidence-based trading. Mechanical trading. Well, that's really evidence-based trading. Algorithmic trading. Well, that's really evidence-based trading because you're looking at an historical equity curve, and ideally you want to see the historical equity curve over out of sample data, okay? Preferably over out of sample data. So it provides evidence that the strategy is profitable, and that's what gives you confidence. And not just confidence to trade it while it's profitable, that but to continue to trade it when you're in drawdown. That's the important thing, right? So that when I'm in drawdown now, I look at what I do, and some of my strategies are quite clever, but the majority of my strategies, I've got my equity curves on my corkboard, my setups on my corkboard, and I just go, yes, a lot of the ideas I use are so old, and it hasn't been. They have not been linear. There's never linear. They always imply they have great periods, they have shit periods. They have great periods, they have shit periods, right? They have drawdowns. And so, that by embracing old ideas, doing my historical testing, looking at equity curves over out of sample data, that provides evidence for me that the way I want to engage the markets has an edge. Is it perfect? No, it's not perfect, right? It's not perfect. Nothing's perfect. Nothing's linear in the markets, right? Nothing. But it gives me the confidence that, I'm in a good lane. I've got some guardrails. And as long as I keep myself small when I'm losing, and reduce my position sizes, then I will be alive. I will maintain my capital. It's down a bit. It's not comfortable, but I expect that my strategies will turn up, and I'll be still have my risk capital. I can still take my bets, even though there's smaller bets. I can still take my bets. It's all based on evidence-based trading. So I want to get into people's mindsets that I think we should be open to all the ideas, right? Listen to everyone, who talks about trading. You're not sure whose voice or whose ideas will resonate with you, right? A lot of people come to trading as discretionary traders who will hear an idea, read a book, be inspired, right? And the mistake they make is they implement that idea into the market straight away without looking for the evidence about whether it works, right? So be a sponge, listen to everyone. If an idea, sparks a thought in your head, go, oh, that looks interesting, okay? Go off and look for evidence that it works, right? Because wouldn't you want evidence? Like, it's nice to hear an idea. It's nice to read an idea that excites you. The next step is, before you implement money in the market, look for evidence that it actually works. Like, for example, you may have heard of a tool called the square of 9 or wheel of 9. Have you heard of that? Oh, it's a thing. W.D. Gann spoke a lot about his word, wheel of 9 or the square of 9. It's like a calculator where it starts with 1 in the middle and it just goes out increments, continuously. It makes this big square of numbers. And, I'll tell you, it does sound, you read it and it talks about how old it is, and you see all these chart examples on how it pinpointed, like a turning point, both in time and price, and it looks wonderful and probably has something to do with pyramids and all the rest. It looks interesting, it really does, But before you try and square a price and a time based on the square of 9 and put the trade in the market, you should look for evidence that it works. So evidence is really the motivation behind why you embrace a particular approach to trading. And I would hope that whatever approach a trader takes, it's based upon evidence that the idea has worked, ideally, historically, over out of sample data, right? Evidence-based trading.
What are the odds that you test something really well, but then when you go live with it, it doesn't work or it doesn't perform as you thought it would when you were practicing?
I've had ideas that look brilliant, and and it's gone straight down. I've been looking at ideas I spend most of my time trying to reinvent and improve my mousetraps. But I just look at really old ideas and I code them up, and I've seen strategies look unbelievable. Like unbelievable, like a just wonderful. And then suddenly it turns into a ski slope and goes straight down. Unbelievable. Like dead set, unbelievable. It's really, really simple ideas for 30 years like this. And then bang, unbelievable. So it does happen. So the way to protect yourself is diversification. So diversification is a fantastic, idea that all traders should embrace. Diversification, not just your portfolio, but diversification on strategy, because it will reduce the risk to you and I of individual strategy failure, right? And that's why, trading equity momentum is so important, that we can think of an idea, we can test it, look for the evidence that this idea works. Hopefully it's simple, but we monitor it, right? We obviously start trading it, we're monitoring it live, aren't we? Because we're getting the wins, we're getting the losses, right? We don't be reliant on a single market or a single strategy, because that single strategy fails, or that single market suddenly behaves differently. You're gone. There's no diversification. So try and have diversification on strategies. So, and that diversification can be not only in terms of, say, trading trend following strategies, and also counter trend or mean reversion strategies. So get diversification on trend, and then counter trend. Have diversification over time periods if you can. Short term, medium term, longer term. Yep. Across as wide or as large as a portfolio that you can afford, so that any individual market failure or any individual strategy failure over a particular time frame is not going to be devastating, life-threatening for you. So go for diversification, and unfortunately, it can happen. Strategies just look unbelievable, dead set, just unbelievable, and then bang, unbelievable.
It's a good point though to never fall in love within one strategy, like one thing, or just try to trade only one thing because you like it or because you know it's going to work a long time, because you cannot really tell if it's going to work a long time.
Yeah. So have diversification. Diversification on, everyone should have a trend trading strategy, right? I know it's really, really hard, but the science says it works. The science proves trading with the trend works, okay? Because the markets are not normally distributed. Despite what all the academic books say, the markets do not follow a normal distribution. There are fat tails, right? So everyone needs a trend trading strategy. I know it's not easy to trade because you only win 3 out of 10. So most of the time you're losing. But believe me, you'd be so happy when you got those 3 trades out of 10 that just carry you to your new equity high, right? So you need that. You also need a counter trend strategy, mean reversion. So do that. And do that over your preferred time frame. Most traders are private traders. Most traders are anxious being in the market. And so most private traders should be focusing on developing a short-term trend trading strategy and a short-term mean reversion strategy, right? And then look at your portfolio. Ideally, I think with $10,000 US dollars, you should be able to trade a diversified portfolio of eight micro contracts, right? The mini contracts. They're 10th of the size of the normal futures contract. They're baby contracts. Yeah. And there's so much good software out there that people can, reasonably quickly learn how to code up and look for the evidence of their particular way they want to trade with the trend. Look for evidence the way they want to trade against the trend, like a mean reversion strategy. Build trend, a counter trend over a short time frame. Try and make the strategy simple, right? And apply it over a diversified portfolio. See how you go. And, if the evidence is there, then you're on your way.
It might be tough for traders to kind of look into multiple systems. I know a lot of people want to kind of work their way and build their own system too, and that takes more time. Where can they go to learn more system or find more ideas of new systems to implement?
Yeah, look, I'm a big believer. The biggest gift, in my opinion, that a trader can receive in looking for ideas on how to approach the market is to have an idea that's really, really old that allows you and I to look for evidence over out of sample data. Believe me, every strategy has a drawdown. And when you're in a drawdown, you want to maintain the confidence in your strategy, right? So that you keep trading it. And maybe what you do is just reduce your position size, reduce your portfolio, and you keep trading it because you know the idea is 30, 40, 15, 20 years old, that it has worked historically over the out of sample data. And despite it being now in a drawdown, because over the last 20 years, it has been profitable, you expect it to be profitable again, okay? So look for an old idea, right? So the greatest gift the market can give us is evidence based on out of sample data, right? So it's essentially, people have to understand that winning strategies have two main criteria. So in the back of people's minds, right? If you want to develop a winning strategy, because who doesn't want to develop a winning strategy? I mean, we all want to develop winning strategies, right? So profile all the winning strategies. If you look at all the winning strategies, they've got two key components. They're all measurable, right? Very clear rules. There's no ifs or buts. There's no gray area. There's no opinion. It's factual. What's a setup? Where do you enter? Where do you place the stock? Where do you get out, right? It's measurable. And the second key attribute of winning strategies is they're robust, right? They are robust. You know, sure, they have drawdowns at times, but over longer term, they have a rising equity curve. Now, in terms of robustness, there's two ways to view robustness. One is out of sample data. The strategy is 20, 30 years old, and you build an equity curve over the last 30 years and it's upwards. That's a demonstration the strategy is robust. If you don't want to look at an old idea and you want to be like these early pioneers and you want to develop your own ideas, then another way you can judge robustness is look for indication of robustness. So if you want to design your own strategy because you've got this idea, and there's nothing wrong with that, but keeping in the back of your mind, you want to develop a robust strategy. So the indication of robustness is whatever you trade, even though you may not want to trade one or two markets, you have to test your idea over a diversified portfolio of markets. Because an indication of robustness is versatility. Is your idea strong enough that it can trade over a large basket of markets, even though you may only choose to trade currencies or only choose to trade one currency pair, right? That the idea you want to trade should be profitable over a large portfolio of markets. So that's a key indication of robustness is versatility. Is the idea that you wish to trade, is it profitable over a diversified portfolio of markets? Another key indication of robustness is whatever you decide has to be simple. Yep, has to be simple. Simple design. So few rules, few indicators, few variables. Because the more rules you have, the more indicators you have, the more variables you have, the more complexity you have. And when you do a sensitivity analysis and you look at all of the alternative equity curves in the parallel universe, you may have your preferred variable values, preferred indicators of your strategy, but because you've got so many rules and so many variables, that they can all be tweaked, right? The more that you have, the more alternative equity curves reside in a parallel universe, where parallel traders have got a different variable value for that particular indicator, right? You need to measure all of those alternative equity curves to ensure that not one of them has a risk of ruin above 0%. Because even though in your heart of hearts, you think, I've got the right variable values today, there's no way I'm going to play with these variable values, I can assure you that over time, you will play with those variable values, right? And so that, today you got an equity curve or variable values you wish to trade, I can assure you in 6 months or 6 years' time, those variable values will change. And so you'll be trading an equity curve that actually was in your parallel universe of 6 years ago, right? Well, you should know today whether that possible equity curve you may be trading in six years' time has a risk of ruin above 0%. So try and keep the strategy simple, because the more complex your strategy is, the more number of alternative equity curves. If you have like 4 variables in your strategy, and I think, I'm not a mathematician, but I think you would have potentially 256 alternative equity curves based on that strategy. That's only assuming that you adjust each variable by 10%, twice above your variable value and twice below your variable value. So if you've got 4 variable values in your strategy, maybe you've got 2 indicators, and each indicator has 2 variables, right? If you've got 4 variables and you only adjust each variable twice above and twice below your preferred value, and I'm only talking about 10%, right? So I'm not talking about big changes, just a 10% and a 20% above, and then 10% and 20% below, right? You do it properly. There's 4 changes across 4 variables. I believe you'll have potentially in your parallel universe 256 alternative equity curves. You need to calculate all of those and calculate the risk of ruin one, sure they're at 0% risk of ruin, right? Now, that's a lot of work. But the more variable values, the more variables you have, the more complex your strategy is, and the more fragile it will be, right? So the idea is keep things simple. To get ideas on where to get ideas for trading, go back and look at some old trading books. Pick up a book from 1980, right? There's heaps of trading books. If an idea in a book from 1980, looks interesting, code it up and have a look at the equity curves from 1980, right? And if it's profitable, there you go. That's your gift. That's your gift. You have, like 40 years, 43 years of out of sample performance. So my suggestion is don't try and reinvent the wheel, because despite how clever you and I are and how clever we are with our brand new wheel, a brand new wheel does not provide any evidence of robustness. We can look for indication, because yes, it will be profitable, versatile over a diversified portfolio. It can have could be a very simple design. It can only have 1 or 2 variables, so that it could be indication that what you developed is robust. So that's a big tick. You know what? Rather than trying to reinvent the wheel, why not go back to some old books and cut up some old ideas? Because that idea was published in 1980, and look at the equity curve, right? That's real evidence of out of sample performance. That's what's going to give you the confidence to keep trading it when you go into a drawdown. So I think, encourage people to look at the old books, and that's what I do. I just look at old books and go, that's interesting. In my latest book, The Universal Tactics of Successful Trend Trading, I look at a whole bunch of old strategies, like really old ones. I look at strategies that go back to 1800, over 200 years old. I look at a strategy which is over 100 years old, 70 years old, 40 years old. So they're old strategies. You don't have to reinvent the wheel. Just pick up some old books, read them. If an idea excites you, then code it up so you look for the evidence that it works. Yeah. So no need to reinvent the wheel. Start looking at old books, code up the idea, and then look for those strategies which have the most appealing looking equity curve. And, you're on your way.
One thing I had in mind is, how would you take off discretion from your strategy? Like, let's say you hear something that has some discretion in it, and you want to be able to code it, make it more like systematic, how would you kind of take that discussion part off?
Yeah, well, certainly a lot of discretionary ideas sound exciting, right? And they sound exciting because they haven't shown you an equity curve. Okay, that's why it sounds exciting, because there's no doubt in your mind. You know, they talk about, you know, well, we have this set up, and you look at the markets at the moment. The markets are at really interesting stages. Like gold is just going nowhere the last couple of years, and it's just been meandering around. I look at large time frames, and gold has been meandering around. Its decimal value area, and it's also currently around its annual value area. So on a decimal 10-year time frame, you know, gold's around the middle. On the annual 12-month time frame, it's around the middle. You know, like it's poised to go either up or down, right? In my belief, all trends commence from a value area. So, I believe that, you know, in markets, you know, obviously trend, but they commence a trend from a value area, and they'll trend, and then what markets do is they move and they revert, you know, back to support or hit resistance, and when they retrace, they usually retrace back to another value area, and the values they're strong, it will continue on. And so gold is at this 10-year and 12-month value area. I've got no idea where it will go, but you can look at charts, and you can look at this 10-year and this 12-month value area, right? So this is like a discretionary idea. I'm talking to you discretionary. I'm saying, you know what? We know markets, they basically, you know, they do trend, and the good trends commence from a value area or support and resistance. I like to call it value. You know, there's value there, so people are coming in to support the market, right? And I can tell you that you look at the market over a 10-year period, you can see how the market actually looks at values. Can we share screens? Okay, this is actually gold. This dashed line here is essentially my annual 12 months value area. And you can see it's just coming down to support here, 1914. The green dashed line is the decimal 10-year one. And you can see how the market came down, you know, to 1751. See the support here? You can see it sort of had the resistance, but it's found support here. So on a longer term time frame, the gold is found support here. So I believe markets, you know, they do trend, and trends commence from a value area, and the value area on the 10-year basis is the green dashed line here around 1751, and you can see it's found support, so it's moving up. But markets are fractal. They operate across all time frames, whether it's 5 minutes, 5 hours, 5 weeks, 5 months, 5 years, 10 years, multiple time frames. This black line here is the annual value area, and you can see how the market's coming down to it 1914. And you can see here over the last couple of years how the market respects this value area. It's coming up resistance, got above it, came down support, fell away. Got support over the 10 years, came up, mucked around here a bit, it's coming back to test it. Markets revert back to value areas. That if 1914 holds on gold, I would expect gold to head higher, because it's very well supported on a 10-year basis. See here, this is the 10 years, right? This is huge time frame. 10-year value area is up, and then on a 12-month value area, it's about to hit support. So if the market can move up here, then I would expect it to go higher, much higher. That's a discretionary idea. Okay, that's discretionary. I'm not providing you any evidence that what I'm suggesting will work, right? I'm not. It's just a discretionary idea. So what you have to do is take what I've just said and convert it to a mechanical system. You could just simply have, if the market is currently trading above your 10-year value area, then all you can do is look to buy. If the market is trading above the 12-month value area, all you can do is look to buy. So essentially, you have a dual trend system. Make sense? A dual trend system. What's the trend over the 10 years? What's the trend over 12 months? So you have a biasness, right? You have a biasness to trade up. Yep. So you got your trend. And if it's in conflict, you can't trade against the conflict, right? If I want to sell gold, I would be saying, well, is gold below its 10-year value area? And obviously it's not now. If gold was down here, I'd be going, well, yes. Is gold below its 12-month value area? Obviously it would be. And I'd be thinking, well, all I can do is look to sell it. So your setup would be, what's your dual trend saying? So you got to convert this discretionary idea into a mechanical idea. And then you build upon that, and then you think, well, how can I find a trigger, right? And you may say, you'll wait for a doji bar to overlap the 12-month support area. Yep. And if the overlaps the 12-month support area, then you may say, you know what, we have a setup. And now we want to count down before we enter, right? So the setup is the dual trend, market's above its 10-year value area. The market at the moment is sitting on its 12-month value area. It's engaged the 12-month value area because it's overlapped. But you know what? We will not trigger a buy signal as the market can rally and say, take out a 3-bar high. Yeah? Take out a 3-bar high. So that'll be your entry level. And then you go apply a simple trading stop and apply a simple exit strategy. So that's a discretionary idea. That you hear an idea and you just think, well, I like that idea, and to just break it down into blocks. Makes sense. Let's look at another example. Do the euro currency. This is very interesting. That up here, the euro currency at 133.49, that is the decimal or the 10-year value area. And the euro currency is way below that. It's super weak, right? Long term, the trend for the euro currency is down. As you can see, the market's just terrible, right? On a 12-month basis, you can see how the market's oscillating around the 12 marks, around the 12-month value area. And then it fell below at 12-month value area, and it commenced to trend downwards. You see that? Now, these levels here are potential support and potential resistance. Okay? And we can see on this potential support area that we got, it was resistance that came down. Guess where it got support? This green line here is the decimal support area. So this is your decimal 10-year value area, and this is your 10-year support area. Now, these value areas are simply pivot points. Are you familiar with pivot points?
Yeah.
Yeah. So this dashed line here, this value area. I'm sorry, I should have, to make it simple for people. This is essentially a 10-year pivot point. That's all it is. So my value area is a pivot point. It's just the average of the previous period's high, low, and flows. You take the average, and that's I believe, is the value area. Black line here is the 12-month or the annual pivot point. I just take what was the high last year, what was the low last year, where did it close last year, average that, and that gives you your value area. Make sense? So these are just multiple time frame pivot points. For your 10-year, that's the 10-year resistance level, and this green here is the 10-year support level. And see how the market knows what these levels are. They're coming into the new year, 2023 in here. Look where the euro currency is balanced. Look how it's just been meandering around the 12-month pivot point or value area. Look at that, going nowhere. This is chopping. And it's meandering around the 10-year support level here. So I suspect the market takes out 110.35, you'll get a movement up to at least 118.69. Now, these are discretionary ideas. And so you got to take these discretionary ideas and you got to build it into a mechanical system. Make sense?
Yeah, makes sense.
Yeah. Now, a lot of discretionary ideas will not convert into successful mechanical strategies, right? Because most discretionary ideas, rely on opinion. Can you see a particular chart pattern there? It's like looking at clouds. If you look at the cloud, you can see all sorts of shapes and clouds. But unfortunately, with discretionary trading, looking for, say, traditional chart patterns, what I may see as a traditional chart pattern, I may be happy about, you may not see the same one. Okay? Now, this discretionary idea I'm sharing with you is very, very simple. It's just one tool, right? It's a pivot point. Yep. One tool to pivot point over multiple time frames. The decimal, which is 10 years. So for the euro currency, if you look at between 2010 and 2020, you work out what was the highest high of the euro currency. Find out what the lowest low was in the euro currency from 2010 to 2020. And then you find out what was the close of the last decade, right? What was the close on the 31st December 2019? What's the close? You average those three numbers and you'll get 133. You've done that for the 10 years. Do that every year for the annual. Okay, so we're talking about just one tool, which is your pivot point, looking over multiple time frames, and then you can do your support and resistance levels. So just pivot points. And when you get two overlapping, like we have here, very significant. And look how the market really, in 6 months, the market's just been meandering around this level. Buying above here or selling below here could be interesting, right? But this discretionary idea is probably a very simple discretionary idea, just using a pivot point over multiple time frames, and people should be able to code up a strategy based around that. But that's what you do. You just talk. It's a discretionary idea, right? I'm not showing you any equity curves here. I'm not showing any hard entry rules. I'm just showing you, sharing with you my belief in how markets work, with some very simple, a very simple tool over multiple time frames. At the moment, all it is between you and I is a discretionary idea. So it's up to the trader to do as they choose.
It's interesting because the way you look at the zones, the way most people look at the zones is like visually on the charts based on what they think price will do based on the highs. And you look at it on a very mathematical way, which is pivot point. So it's easy to calculate. And that kind of takes away the discretion there of most traders, which would look at the chart, try to pick the right zones by looking at the charts, and that can lead to some errors.
Yeah, just keep it simple. Try and remove the opinion. You may start with opinion, start with an idea, a discretionary idea, and then just try and bring it down to some hard rules. Talk to your other traders, get some ideas, and go, okay, that sounds interesting. How can we code it up? And the trick is, don't have too many rules. And all this discretionary idea is just one tool. It's pivot points over multiple time frames.
I really appreciate the advice you give here to my listeners. So maybe we can wrap it up. We've been already an hour in, but what can people connect with you or find out more about your work after this interview?
Really the best place to start is just get a copy of my books, the Universal Principles of Successful Trading, which is a very holistic book. But I believe the process of trading is the most important thing. It's far more important on whatever market you want to trade. Far more important on what time frame you want to trade. Far more important on what technique you want to trade. This universal principles that are ironclad. They are ironclad, and you have to embrace them. Otherwise, you won't survive. So that's probably the first book. And if you enjoy reading my Universal Principles of Successful Trading, then I'll encourage you to get my latest book, which is the Universal Tactics of Successful Trend Trading, where I talk about how look at some old ideas and code them up. There's no need to reinvent the wheel. So, and if they like those two books, then certainly they can jump on my website and have a look. And there's plenty of information on my website. And they'll see I am in a drawdown. They jump on my website.
I appreciate being honest about this for sure, and it's a good thing to be real and share the real what trading is really about. So that's a good one for sure. And I'll leave you links to your books below. I know these are good books. I've read both of them, and they're amazing. So I really love those books because they're really down to earth, very like detailed. So I definitely love that kind of content for trading. So I'll leave the link below. Book and check it out. And Brent, I appreciate your time as always. Appreciate the advice you have here to my listeners, and hopefully you can catch up pretty soon and discuss more about trading. That'd be cool.
You're welcome, and thank you for having me.